Good morning, everyone, and happy Friday. Welcome to the update on the current market environment for May 15th, 2020. This is Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo _ CMT. Hope everybody's having a great week and is getting geared up for a good weekend. Let's dive in right now. S&P 500. It's been last week we said it was a 3-week grind. I guess now we can call it a 4-week grind. We've effectively haven't gone anywhere for the past month of trading. Now, it's important to note that support held yesterday, right? We've been highlighting this level around 280, really between 275 and 280. The bears tried to take over yesterday, and the bulls were having none of it. Rallied the market back to close above that important $280 level. So, we've been kind of laying out the roadmap of the important levels, and if they break and if they hold, what we think makes sense. And if you just go back to my note yesterday, I gave you a list of stocks that look compelling should 280 hold, right? So hopefully you were able to implement some of that, or at least it woke you up to the fact that you should be doing work on some interesting names. Now, bigger picture, we'll take a look at breadth a little bit later on, but I still want to see this power bar improve. And really, at the end of the day, we're still below the declining long-term trend line. So important hold, yes. Has anything changed? No. All right, so we're still in that frustration zone. But now we'll see if the bulls can build on yesterday's important hold and make another run at this declining trend line and try to break topside. Small caps, I guess they tried but failed. IWM is neutral. Power bar ratio is bearish. Trend is weak. When I say they tried and failed, is remember we were talking last week about improving relative strength. If you check out my note today, you can see it a little bit more clearly. Small caps have fallen back into the range relative to large caps. I think if you're bullish the market, I think that if you are in the V-shaped recovery camp for the economy, you need to see small caps join the party, and they haven't. There's no two ways about it. They have not joined the party. They've tried, but they're not there yet. That doesn't mean they can't get there, but I think it's an important tell for the market in general. If you want to be bullish the market beyond FanMag and a few other high-quality growth names, you need to see broadening improvement and broadening participation. Small caps is important to that, right? Some of the other sectors that I've highlighted this week in our notes, whether it's materials, whether it's transports, the quote-unquote reflation basket that I look at, those need to start to join the party to give us a sense that participation is broadening. Otherwise, it's really just more of the same, narrowing and narrowing leadership. And while the monsters can drag the market higher, narrowing leadership, really what that does is, even though the S&P is going higher, unless you own the handful of stocks that are dragging it higher, your odds of picking winners is declining. So bigger picture, the average stock is still under a lot of pressure and has not participated to the same extent that the market would have you believe. So move beyond the indexes. I've said it, and I make no qualms about it. If all you do is look at the major indexes, that's great. If that works for you, it's lazy analysis for me. The Qs, they have a gap to fill, and this is they remain the best game in town. The Qs are bullish, have a bullish power bar ratio, have a strong trend, right? They're above the rising long-term trend line. This is a trend that's been in place for a while. This is nothing new. It's not, we didn't wake up, discover that, COVID was an issue and say, let's bid up growth, right? We've been talking about that here for 14 months at least, right? Our thesis has been that growth is slowing. And in a slowing growth world, you want to own growth. And I mean, that's been the right trade trend-wise. We're going to get into why I don't necessarily think it's the greatest trade on earth right now a little bit later on the show. But the Qs have a gap to fill. They tried to fill it earlier this week and faded. I think that would be important. But again, it would just be more of the same, right? It would just be confirmation that our big cap leaders are continuing to lead. And that's fine if you own them. But if you're, trying to broaden out, or, just remember, I mean, the average stock is not doing well. Take a look at something like the Value Line Geographic. how far it still is off its all-time high, which, by the way, was not met in February. So take a look at the Value Line Geographic Index when you have some time this weekend. That'll give you a proxy for what the median stock is doing. Long bonds are moving higher again. This still fits with our thesis of growth over value. This also fits with my thesis that I don't think we've seen the low in rates. And I know the chairman of the Fed has said NERP is not on the table. But what if the market just forces his hand? What if traders bid up the existing treasuries to the point where rates are negative? So the Fed may not adopt the policy, but I don't think it's out of the realm of possibility for the market to just force the Fed's hand, or if not even force its hand, just take rates there, right? And obviously that would be the shorter end of the curve. But if you think about it, the long end is kind of the growth picture, right? If you're willing to own 20 plus year treasuries at a sub 2% yield, if you're making that bet, what are you saying about growth prospects? What are you saying about inflation, right? Or maybe it's just purely a price participation and price appreciation bet, and that's cool too. I think that's certainly part of it. But, if you're piling into long-term treasuries here, I think it's more about return of capital than return on capital at this point. But there's no two ways about it. This has been in a consolidation, and this group was up a like amount as equities yesterday. So that's kind of interesting to me. They're starting to move higher once again. It's something I'm paying close attention to. Now, I'm still looking for better breadth. Here's the percentage of stocks at Chaikin Analytics in the S&P 500 that have a bullish or very bullish rating. And you can see I've hammered this point home, so I'm not going to belabor it here today. I just think that you need to see breadth improve, right? And this kind of speaks to the same theme that I was speaking about earlier, which is participation is concentrated in the large cap growth names. And if you want to be bullish on this market, or if you just want to have better odds of picking winners, it would be helpful if there was better participation there. And it's just not, right? We tried and then faded once again. But what's interesting to me, and I pointed this out last week, and I'll continue to point it out, is this is actually the normal activity, the slow grind out, the choppiness. This is normal after being really washed out. This, the 2018 low and then early 2019 rip, that's the anomaly, right? Generally speaking, check it. I mean, look, it happened back in the early 18. When when this metric gets below 10%, the V up and out is not the norm, right? It's a grind, right? Grinding. You pull back, retest, right? So just something to be aware of. A lot of people want to compare what's happening now and use late 2018, 2019. And while, yes, anything can happen, but I think it's important to understand what's more likely to happen. And 2018, 2019 is not what's likely. It's likely the anomaly. Getting back to that growth over value, taking a little bit of a different look. And I realize this chart is a little cluttered, but bear with me. I'm going to walk through it, right? It's a normal chart that's in my note. The ratio of Russell 3 growth to Russell 3 value and its 200-day moving average. Now, we can plainly see that we're extended from the 200-day moving average, right? But what I wanted to get a sense was realistically, statistically, how extended is this trend? So I drew a regression line. This is a 5-year regression line in the middle with standard deviations set at plus and minus 3. 3 standard deviations above the regression line. We're well above it. I didn't go out any further because this proves my point. So what does this tell me? Obviously, this tells me the trend is strong. This also tells me that I don't necessarily want to chase it here now. Remember, we've been on it for 14 months. We've been on it since here. We've been on it since this breakout. And what's also interesting to me is that while we're extended, we have a negative divergence between price and RSI. So just something to be aware of as you're doing your work, right? I'm not saying, you should be shorting growth and buying value as a hedge. I'm saying that you really need, maybe we are extended and maybe we start to see the turn in the growth versus value equation. You want to sit up, take notice, pay attention, especially especially if you own a lot of the growth names, right? What does this tell me? This tells me the trend is up, but possibly extended. So what are you doing if you own growth names? You are making sure your risk management process is honed. You are making sure your stops are up to date. However you choose to manage risk, I think you want to be paying attention. I think that is how you implement a trend following strategy with strong risk management discipline. You're paying attention to what could be a potential shift from an extending situation, right? We're not guessing at it, right? We're not going to say this is the top and sell everything. Absolutely not. The market will tell you if this is the top in growth versus value, because what will happen, the growth stocks that you own will start to roll over and you'll get stopped out, right? So very similar to if you were following this methodology back in mid-February, your stocks probably started rolling over. Your stops were being triggered, right? You were naturally raising cash as the market was tanking. And the risk management process hopefully allowed you to sidestep a lot of the move lower. The other thing we want to watch on that growth versus value relationship is copper versus gold, right? Because this is the proxy. And again, this is not new. You've heard me talk about it, but here's the top. The top in the copper versus gold ratio is December 2017. Folks, I hate to say it, growth's been slowing for over 2 years globally, right? Global growth has been slowing for over 2 years. COVID's just an accelerant. We'll see what happens from here. But if I was to wanted to make the case that the growth versus value trend, not near-term pullback because it's extended, but trend, if I wanted to make the case that that trend was reversing, I would have to make the case that this trend was also reversing as well. And I don't see it just yet. And I'm not talking about these little counter trend moves. I'm talking about a reversal of this 2 years of downward movement. Something I'm watching, obviously. I give it to you every week on a Friday, right? So obviously I think that it's important, and I think you should be paying attention to it. Finally, we're close to 3 months from the top, right? The top in the market was February 19th, at least for the SPY. So I wanted to take a look and see who the best sectors were over the past 3 months. And no surprise, tech, comms, healthcare, right? We've been talking about all these names. One group that was actually, one sector that was in this group, in all fairness, the financials looked good at the end of last year, right? We started to see a little bit of this reflation trade coming on, a potential growth trade coming on after the deal with China. And the financials looked good. And that ended up being a disaster, right? So what does that speak to? Number one, diversification. Number two, risk management. Because the financials look good from a trend perspective and a momentum perspective at the end of last year. And it was only quick risk management that kind of, or adherence to a risk management process that allowed you to rotate out of those financials and hopefully rotate into something better. So this is where we stand 3 months or roughly 3 months from the high. Discretionary is leading. That's largely a function of Amazon. We talk about that a lot. And staples are defensive. So those are the sectors over the last 3 months. Your takeaways: SPY is stuck between key levels, but the bulls stood their ground. The small caps tried. They did try on a relative basis. And if you're bullish market and you're bullish broadening, you want to see small caps playing. The long end of the curve is strong again. That to me speaks volumes about investor expectations around growth. We still need to see breadth improve further. 3 month sector leadership, we're laying it out for you. I think it's important if you are looking for ideas. That's where you should be looking. And above all else, folks, have a great weekend. Enjoy time where you can. Social distance, be well, be safe. I'll be back next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.